Most of my research is focused in the electricity sector, which is what I'm going to talk about today, and to focus on how companies actually make decisions about what they're going to invest in. We've heard a lot about global trends in the last couple of talks and policies to try and shift those trends. At the ground level, you've actually got to persuade people to do different things with their money, and it's not as easy as you might imagine to do that. I'm going to be talking about risk. It might seem like a slightly odd thing to sort of have to worry about. The electricity sector is quite a mature sector. It's been running perfectly well for the past century, so why are we suddenly talking about risk? Well, there's quite a few changes going on, some of which are policy driven. I'm going to focus in on the UK for the time being here. I'm sure you've talked a lot about some of these policy mechanisms over the last couple of days. I'm sorry I haven't been able to be here with you to listen to those, but we've got policies such as the carbon price floor, contracts for difference and capacity mechanisms, which are all part of this electricity market reform trying to deal with risk in the electricity sector. But those policy mechanisms themselves have a certain risk profile that companies are then exposed to. So companies have to understand, to what extent are the prices that I think I'm going to get under a particular policy mechanism stable over a particular length of time that I need to see a return on my investment. The changing technology mix itself is changing the risk profile in the sector. So we've heard, in order to meet these targets, possibly up to 30% of the electricity sector would have to come from renewables. They have a very different generation profile, and they affect the price formation process in the electricity sector. So they're actually going to change the risk profile of prices, and I'll say a little bit more about that. The technologies obviously have their own technology risk. Some of these are quite new. Nuclear isn't exactly new, but we haven't built any for a long time, so there's quite a lot of technology risk around that. CCS is brand new in a sense, so we really don't know. And fuel price risk, again, not a new risk. I mean, that's been around since as long as these fuels have been traded. But fuel price risk, in some ways, provides an underlying theme behind the whole policy risk about what technologies we ought to be aiming towards. And it's certainly uncertainty about what the gas price is going to be in, say, 2030 is going to be a huge driver as to whether the gamble, if you like, towards major investment in renewables is seen to be politically a successful move or to have been a red herring and a large waste of money. So there's a lot of political risk as well as investor risk tied up in these long-term uncertainties over fuel prices. I just want to, lots of different typologies out there about different types of risk. I want to just point out that revenue risk for investors is just as important as cost risk. It's quite easy to sort of focus in on cost risk, and it's the way policy makers will tend to think, partly for historical reasons, because policy makers used to be in charge of what got built when everything was nationalised. Now that what gets built is, in theory, in the hands of private companies, it's not just about costs anymore, it's about revenues, and you have to worry about how price formation in the electricity markets actually occurs and how those cost uncertainties feed through. So these cost uncertainties will feed through to the revenues, and they will impact across the technology portfolio in ways that might be slightly unexpected. So, for example, price risks bear upon all technologies. So that means that for, electricity prices will tend to be driven mostly by fossil fuel prices because they tend to be the marginal plant on the system. So gas price uncertainty will tend to drive electricity price uncertainty, and that affects the revenues that accrue to nuclear plant and renewables plant because they're basically price takers in the market. So you might think that because nuclear doesn't use any fossil fuel, the price of fossil fuel is irrelevant, and to some extent, at a national level, having some plant in your system which is not subject to fossil fuel price volatility and uncertainty can actually be a good thing in terms of dampening the risks that they pose to the price of the system. But if you're a single generator operating a single plant, your revenues are directly linked to those fluctuations. So you see those as a risk. And in fact, you're more exposed to those risks than the gas price producers, because the gas producers will see those variations in both their costs and their revenues. To some extent, they're actually naturally hedged against fuel price volatility, because they can pass that through to some extent to the market price. Whereas if you're just a price taker with a constant cost base, you'll see the whole electricity price volatility feed through to your revenues. So we can see that just in an illustration. These numbers are from a rather old report. I apologise that the actual y-axis numbers are rather a long way out, but it illustrates the point. If you look at, this is a sort of a cost-based view of levelized cost comparison across different generation technologies. And it's a very sort of traditional way of comparing different types of technology. So this is looking at gas, coal under different cost assumptions, nuclear under different cost assumptions. And you'll see how out of date the high nuclear capital cost assumption is here. Still, the point being that when you look at this, a lot of the variation in cost here is to do with uncertainty in the gas price. I'm talking about long-term uncertainty, not short-run volatility. When you translate that into revenues, an NPV calculation, you get a very different picture. Gas actually looks a much safer bet. And if you look at the amount you might lose, which is typically what people are worried about. If you go to a bank for a loan, they worry about how much you can lose. They don't worry about how much you can make, because they're worried about whether you can repay the loan or not. Which of these is most likely to be able to get a loan from a bank? That graph tells its own story. So translating from costs to revenues can actually turn the picture of risk upside down from what you might expect when you take into account the price formation process. This message is very much sort of fed through into policymakers' minds, and it's sort of precisely why the electricity market reform has taken the sort of steps that it has. You've seen progressively sort of nuclear generators arguing, we don't know what the price of carbon is going to be, you've got to fix that. Okay, we fixed that. No, we don't know what the price of electricity is going to be, you've got to fix that as well. So you're progressively seeing more and more levels of request from the industry to say, you've got to protect us from all of these risks. Is that a good idea for government to protect companies from these risks? That's certainly an open question which we're trying to sort of understand. I mean, transfer of risk should be to those who are best able to manage them. At the moment, it's being transferred basically to the consumer. I would argue that risks need to be thought about in two different ways. There's essentially kind of long-term risk. Examples of that would be CO2 prices, long-run fuel price uncertainty, technology costs, etc. These are things that play out over sort of 5, 10, 15, 20 years' time. They affect the long-run revenue that you're expecting to get as an investor in a technology. And they affect your choice about what it is you think you should be building, because that's the period of revenue that you're going to go out to. CO2 prices do vary more rapidly, but given the structure of the CO2 market, the long-run expectations about CO2 is set as a long-term trend. Short-term price risks affect the day-to-day and year-to-year performance of the investment. So here, you're going to worry about volatility of prices. You're going to worry about wind power availability and how that affects the prices in the market, and I'll come back to that. So just thinking about long run, I'm going to take the example of carbon prices. A very simple view of how carbon prices are formed in a market. Essentially, these are the abatement options that are available in a carbon market, stacked up in order of increasing abatement cost. And the target is some politically driven target, which is announced. So currently in the EU ETS, it's 20% roughly. And that sets the expected price. Now, of course, life isn't that simple. All of these are uncertain, so you might not know exactly what the abatement cost is, and these things might vary according to whatever the prevailing fuel prices are, etc. And that's true for all of these abatement options. Perhaps the most important uncertainty is what the level of demand is and economic growth, particularly driving demand for abatement. So if you think about the emissions profile over time, you've got a kind of a baseline business as usual. The cap is set at some level below that, in theory, although at the moment, obviously, the cap's actually higher than business as usual. But there's uncertainty around what that business as usual level of emissions is. So there's this abatement target isn't a fixed number, essentially. It's actually an uncertain amount of abatement that's going to be required in the market. So if we put that back into this map, essentially that uncertainty in abatement requirement is going to drag your curve either left or right, and get so creating quite a range in expected price. So the other thing we might have to worry about is policy interaction. So in the case of renewables, for example, they're quite expensive in terms of an abatement option at the moment. But we're requiring them to happen. So essentially you push them in at the beginning of the curve. So instead of waiting for that to happen as a result of higher increase in carbon prices over time, you make them happen first. You've pushed the rest of the curve off to the right, and that actually suppresses carbon prices. So all of these kind of different climate policies all interact, and energy efficiency targets will do the same thing. If you're pushing in 20% energy efficiency, arguably you're going to achieve your 20% carbon target there without even trying with the EU ETS. So this is partly a combination of these factors is what we've seen in the EU ETS, and this is some modelling that we did of carbon prices, which this was the pre-recession sort of probability distribution of prices in 2020. Post-recession, effectively what we saw was a big reduction in demand in the system. And as you can see, the most likely price coming out is zero, effectively, which is kind of what we're seeing in the EU ETS. So what does this mean for the investment decision? Well, one of the ways we've been evaluating this is using a real options framework. And so the colours aren't very clear. Actually, there's supposed to be a kind of an orange shaded patch here, which is the annualized capital cost. So if you're thinking in a very simple way about whether or not you should invest in something, typically if your margin if your gross margin is higher than your annualized capital cost, as long as that gap is positive, that's your profit. So typically you would invest as long as that gap is positive, right? Now, obviously the future's uncertain. If you were to be evaluating this investment proposition and somebody said to you, well, there's a chance that it could go higher and there's a chance it could go lower, would you invest? If you're a rational investor, you should say, well, if there's a 50% chance of either of these, the average is still that orange line in the middle. Yes, I will invest. NPV is still positive. I'm happy to go ahead. As long as I can invest in enough of these things, on average, they'll all pan out and I'll make a profit. In reality, companies quite often have flexibility over when they're going to invest. So if you can delay your investment until this point here, you might be able to decide whether or not you're on the upper path or the lower path. And obviously, if you decide you're on the lower path, then you wouldn't invest. And if you're on the upper path, you would invest. So you could actually, by waiting, you can avoid this potential loss. You've foregone some income because your plant hasn't been up and running, so now your investment decision becomes not, is my expected investment positive NPV, but is the possibility of avoiding a loss by waiting outweighed by the cost of waiting. What this means in practice, here's a map of, again, these numbers are slightly out of date, but it illustrates the point. This is a kind of a break-even map of what you might invest in with a limited number of technologies on there. It's just coal, CCGT, and then CCS applied to each of those. So this is the break-even point. which divides your decision about what to invest in based on a coal to gas ratio along here and a carbon price. So if carbon price gets high enough, you start to get interested in carbon capture and storage. This is high gas prices, you would invest in coal. Low gas prices, you'd invest in gas. So that's your kind of map. Now, a positive NPV rule would give you infinitely narrow lines between these points on the map. You know, if you flip from one side of the line to the other, then you would change your decision about what to invest in. Uncertainty sort of opens up a wedge, and so this is the sort of value of weighting area. If you're in one of these grey areas, you'd actually rather sort of wait and see, and what we're modelling here is uncertainty in carbon price, actually. Now, you can close those wedges back up again by making the sector very profitable, because again, if the sector's very profitable, then waiting is not a good idea. You know, if you wait, someone else is going to jump in. So if you've got very high electricity prices, lots of profit to be made, there's going to be no problem getting people coming into the sector. Obviously, the problem is high electricity prices, high profits are politically anathema. They don't seem to be politically anathema in other sectors. I mean, nobody worries about sort of, biotech companies making high profits, and the oil companies seem to get away with making pretty decent profits. For some reason, electricity is much more politically sort of sensitive, and it may be that it's because its privatisation only occurred relatively recently. It's still seen as a public good. So high profits, one solution, politically difficult. Okay, so that's long-run risk. I probably ought to speed up a little bit. Short-run risk, I'm just going to illustrate very briefly. Again, I mean, electricity price formation in theory, just like carbon price formation, you stack up all your generation sources in order, and whatever the electricity demand is at any particular time sets the price. Now, the thing about increasing the amount of renewables is that the short-run marginal cost of renewables, and nuclear is the same thing, is very low, potentially even negative, actually. If you're a renewable generator who is being paid an additional allowance from a green credit to run, you would potentially be perfectly happy to run at negative electricity prices. So in any case, you've got a bunch of generation down here with quite an uncertain level of generation due to wind variability, etc. Now, the more of this stuff you've got in here, the more likely it is that your price generation actually isn't set by what you're used to the price being set as with the fossil fuels. You could actually end up periods of time during the year when the marginal price falls very low, possibly even negative, if you've got large amounts of wind on the system. And we've seen examples of that in Germany. You've probably heard about that during the course of the conference. So here's some analysis of what that means in terms of prices in our modelling. So it's probably hard to read the scale here, but in a baseline scenario, which is roughly what we have today in the electricity system, you get a nice sort of roughly normal distribution, a little bit of upside. So if you went to a bank and said, can I get a loan, 4 minutes, can I get a loan for this project? They'd sort of look at that and think, okay, that looks sort of like risks we can handle. If you go to a bank with this project, this is where you've replaced a large amount of coal with wind in the system. It looks a bit more messy, but significantly there's there's some finite possibility, not a large probability, but some possibility of periods of time with actually negative pricing. This is saying the same thing effectively. As you drive in more wind, this is the probability distribution of prices. So you get a pretty significant downside risk. And if you're a gas generator, this is the number of hours. So this is basically full-time base load expectation of where you would want to be if you're building a new power generation unit. If you've driven a lot of wind into the system, you'll be expecting to generate with much fewer working hours. Now, obviously, that's not necessarily a problem. I mean, that's a system-wide cost, which is well understood. So, I mean, the system cost is that, that just has to be factored in. From a individual investment point of view, you've got to think about how do you generate the incentives for people to build things when they're going to be reducing hours. So these are basically the factors which have fed into the government's thinking in the electricity market reform. So they've got the carbon price floor, fixed feed-in tariffs, and then in terms of the short-run risk, the capacity mechanism is essentially there to deal with the fact that some of these generators might only be running for a significantly lower period of time during the year. Potential solutions to creating viable investment incentives for this, there's a number of solutions. One is that you just allow the companies to aggregate and exert market power and raise prices through cartel. I mean, to some extent, there's arguably a pretty uncompetitive structure at the moment anyway. But the margins in the system are pretty tight. You could allow them to do that, or you could just say, well, do we really need such a reliable system? You know, let's just ramp down the amount of reserve margin on the system, let the whole system run tighter. It might fail a bit more often, prices would go up, but that would allow a sufficient investment signal for people to actually come in and invest in things. Neither of those things are very politically palatable. Again, coming back to this issue that if the lights go out, it seems to be politicians that get blamed rather than the energy companies. I'll come to a conclusion. So the question is whether companies are going to invest. This is their debt levels, and this is their return on investment. So the utilities are Europe-wide are having a tough time, and the financial case for them to invest large amounts of capital in putting into the electricity system is really suffering. So it's not a good time to be asking them to come out with money. A bunch of places you could go to look for money other than utilities, but certainly, I don't have time to go through this right now, but it's absolutely not clear that any of these other people, fundamentally, if the electricity market is not looking attractive to invest in because electricity prices are too low, why would any of these other kind of institutional investors, etc.? It's rather fashionable to sort of talk about pension funds coming in and funding the electricity system, but it's not obvious that there's an incentive for them to do so. I'll just leave that up there. Essentially, a bunch of things that of risks and ways that the government is trying to deal with these. I'll just end on the final point, which is that risks. There's a lot of talk about de-risking of projects, and I think, arguably, to get the thing moving and to get demonstration of projects, etc., I think that's reasonable. I think I need to point out the risks don't disappear. You move them around. It's only efficient to move them around if you're moving them to people who are best placed to manage them. At the moment, it feels as though that's the consumer, and I'm not sure that's been fully thought through. So thank you very much.